Welcome everyone to the first session of finance of C4S classes. Here we'll be discussing MCQs related to finance which might come in UIIC AO exam. Okay, so let's start with the first question, which is which of the following statements best describes factoring in finance? So first option is it is a process where a company borrows money from the bank against its future sales. Next option is factoring is the sale of accounts receivable to a third party for immediate cash. Third is it refers to the issuance of new equity by a company to fund its operations. Next is factoring is a method of restructuring a company's long-term debt to reduce interest costs. And then it involves issuing bonds in exchange for future revenue streams. Okay. So the answer for this question is B, that is, it is the sale of accounts receivable to a third party for immediate cash. So what happens is if it there is a business and this business is doing, you know, uh, there is certain sale done by this business to this entity. Okay, let's suppose the cost of sale was 100 rupees, and now according to the conditions of the deal, this entity is required to pay the business the money in 90 days. Okay, so 90 days is the time period. But if there is a condition that this business requires immediate money, then what this business will do, this business will approach a factoring unit. Okay, so this factoring unit, what it will do is it will give a discount on the money that this business is required to receive from the entity. That means this factoring unit will say to this business that we will provide you 95 rupees, you know, instantly. Okay. And we will take the responsibility of collection of the payment, that is 100. Okay. After 90 days. So this business will be able to get 95 instantly, and the amount that this business was supposed to receive from this entity will now be collected by the factoring unit. So in this way, this business will be able to handle its working capital efficiently by doing by factoring its receivables. Okay, so this whole process is known as factoring. So this process gives instant stability. Okay, and another advantage is it doesn't require borrowing of money by the business. Borrowing of money not required. Okay. Now moving on to next question. So what is short selling in the context of financial markets? First option is buying shares of a company with the intention to hold them long term. Next is selling stocks at a loss to reduce tax liability. Third is borrowing shares to sell them with the aim of repurchasing at lower price. Fourth is purchasing shares directly from a company during an IPO. And fifth is holding stocks for a short duration before selling them. Okay. So answer for this question is C, that is borrowing shares to sell them with the aim of repurchasing at lower price. Okay. So what is this short selling? Actually, short selling is a speculative strategy. And this speculative strategy is quite used in declining markets. So how traders make profit from this? So the in declining markets, what happens is price is going down. So what a trader does is trader first borrow stocks from a broker. Then it will sell the stock. Okay. So here it will be selling stock. Let's suppose a stock was trading at 100 rupees. So it will the trader will borrow the stock and sell the stock at 100 rupees. Now the market is declining, and let's suppose the price comes down to 90 rupees. So the trader has already sold the stock at 100 rupees. He will be getting 100 rupees in his bank account. Now, trading account, sorry. So in third step, what he will do, now when the market price of that stock is 90, he will buy the stock at 90 rupees. Okay. So 10 rupees remains in his bank account. Okay. So that will be the profit from this trade. And this stock will be returned to the broker. And this whole process where he first sells, then buys, it's called squaring of the trade. Okay, that he completes the transaction by returning the stock to the broker. Okay, so this is what short selling is. Okay, so next question is, uh, which of the following statements correctly describes treasury bills? So first option is, T-bills are long-term debt securities issued by the government to finance infrastructure projects. Next is, T-bills pay periodic interest to investors and mature in over 10 years. Next is, T-bills are short-term government securities that mature in 1 year or less and are issued at discount. Fourth is, T-bills are issued by corporations to fund working capital requirements. Next is, T-bills are similar to stocks and represent ownership in government-backed companies. So the answer to this question is C. So basically, T-bills are short-term government securities, okay? And their maturities of these T-bills are typically 91 days or 182 days or 364 days. Another characteristic of T-bill is they are issued at discount, okay? Issued at discount. This means they do not have coupons attached to them. Coupons means interest coupons attached to them. That means if you want to buy a 100 rupees T-bill, then it will be issued at, let's suppose, 96 rupees. And at maturity after 91 days, you may redeem it by 100 rupees. So you are paying 96 rupees and getting back 100 rupees. So you are making a profit of 4 rupees on 96 rupees that you have spent. And this will be the yield that you have, or the rate of return that you got from investing in treasury bill. Okay. Now, before moving to next question, this is a reminder that we have launched UIIC AO exam crash course. Here we'll be providing full-length test series. Along with that, there will be some special sessions for finance, just like this one. Okay. And these are the other features. And for more details regarding the test schedule, you can visit our Telegram group also and our website too. Okay. Links are given below. Okay. Moving on to next question. In finance, what does the term grace period mean? So first option is the time period during which a borrower doesn't have to pay any interest or principal due after the due date without facing a penalty. Next is the initial period in which the loan is interest free. Next, the time frame within which a loan must be fully repaid. Next is the period during which a borrower's loan repayments are applied only to the interest portion. Next is the time given to a borrower to increase their credit score before loan approval. So the answer for this would be A. Okay. So what is this grace period? So typically a grace period is that, let's suppose you are supposed to pay a premium or a payment in 30 days. Okay. And if you have not paid your money within this 30 days, then a certain period will be extended or given to you that in case you pay your premium in this period, then you will be not incurring any late fees or penalties. Okay. So this special period that is extended is known as grace period. Okay. And typically this grace period is typically related in insurance business. Okay. Where you are supposed to pay your premium to a particular due date. So after due date, a certain time period is given within which if you pay your insurance premium, then no penalty will attached or no penalty will be included in your payment in the future. Okay. So that period is known as grace period. So typically, if you are making monthly payments of premium, then the grace period is 15 days. And for yearly payments of premium, it is 30 days. Okay. Now moving on to next question, that is, what does an IPO involve? So first option is a private company offering bonds to investors to raise capital. Next is a private company issuing shares to the public for the first time to raise funds. Next is a public company issuing additional shares to existing shareholders. Next is a company repurchasing its own shares from the open market. Next is a process where private company buys out another company to expand. Okay. So the answer is B. That is a private company issuing shares to the public for the first time. So this first time is the keyword here. So basically, a private company, when it wants to raise more funds, they will ask public to contribute capital to them, and in return, they will issue shares. So the process where these shares are issued to the public for the first time, that process is known as initial public offering. Okay. So this IPO helps companies to raise capital from public investors. Okay. Raise capital from public investors. And these shares then are traded publicly. So after raising capital, these shares that these public investors get, these shares are traded on the secondary market, just like in stock exchanges. Okay. So this is what IPO is all about. So that's all for today's session. Thank you and have a nice day.